Australia's inflation story has entered a new phase, and it matters more than ever for anyone thinking about property. According to the latest ABS monthly CPI figures, inflation is continuing to ease compared to earlier peaks, but it remains sticky in key areas that directly affect households. While the headline number has moderated, everyday costs like housing, insurance, energy, and services are still putting pressure on budgets. So what does this really mean for buyers, homeowners, and investors in 2026? In this video, we'll break down what the latest inflation data is telling us, why it matters for interest rates, and how it feeds directly into property prices, borrowing power, rents, and investment decisions. Let's start with the big picture. Inflation measures how fast prices are rising across the economy. Over the past few years, Australia saw the sharpest inflation surge in decades. While recent data shows inflation has cooled from those highs, it hasn't disappeared. Instead, it has become uneven. Goods inflation has slowed as supply chains stabilized, but services inflation remains elevated. This matters because services include rent, insurance, education, healthcare, and trades, the very costs households can't easily cut back on. Housing remains one of the biggest contributors to ongoing inflation pressure. Rents are still rising in many cities, construction costs remain high, and insurance premiums have surged. Even as some prices stabilize, the overall cost of living stays elevated for many Australians. Now let's talk about why this matters for interest rates. The Reserve Bank's job is to keep inflation under control. When inflation stays higher than desired, the RBA has less room to cut rates quickly. Even if rate hikes pause, higher for longer interest rates become the risk. For homeowners, this means mortgage repayments remain a major pressure point. Many borrowers who took out loans during the ultra-low rate period are still adjusting to much higher repayments. Even small changes in rates can significantly affect monthly cash flow. For buyers, inflation directly affects borrowing power. Higher living costs mean banks assess loans more conservatively. That reduces how much buyers can borrow, which in turn influences how much they can pay for property. This is where inflation and property prices become closely linked. When borrowing power is constrained, price growth tends to slow. We're already seeing this dynamic play out differently across cities and suburbs. Some areas remain resilient due to strong demand and limited supply, while others are more sensitive to changes in household budgets. If you're enjoying this, hit like to help more people find this video. Now let's look at inflation through an investor lens. For investors, inflation is a double-edged sword. On one hand, rising rents have helped offset higher interest costs in many markets. Strong rental demand, low vacancy rates, and population growth have supported rental increases across much of Australia. On the other hand, higher costs are eating into net returns. Insurance, maintenance, strata fees, property management, and borrowing costs have all risen. This means gross yield figures can be misleading if expenses aren't carefully considered. Inflation also affects investor behavior. When rates are high and costs rise faster than rents, some investors choose to sell. In pockets where multiple investors exit at once, localized price pressure can emerge, particularly in areas with high investor concentration or oversupply. This doesn't automatically mean a crash. Historically, inflation-driven adjustments tend to be uneven and localized, rather than national and sudden. So what does the latest inflation data suggest for property in 2026? First, it suggests that the era of ultra-cheap money is firmly behind us. Even if inflation continues to ease, interest rates are unlikely to return to the emergency lows of the past. Second, it reinforces the importance of fundamentals. Areas with strong employment, population growth, infrastructure investment, and limited new supply tend to cope better in higher inflation environments. Third, it highlights why cash flow matters more than speculation. In a higher-cost world, properties that can support themselves through stable rental demand and manageable expenses are more resilient than those relying purely on capital growth. For first-home buyers, inflation changes the strategy. Stretching to the maximum borrowing limit becomes riskier when living costs remain elevated. Building buffers, choosing locations with long-term demand, and prioritizing affordability over fear of missing out are critical. For upgraders, inflation affects timing. Selling and buying in the same market can offset some price movements, but higher transaction costs and borrowing constraints still need careful planning. For investors, the message is clear. Inflation rewards discipline. Understanding true cash flow, diversifying across locations and property types, and planning for higher expenses are no longer optional, they're essential. Now let's address the big question many people are asking. Does easing inflation mean property prices will surge again? Not necessarily. Lower inflation reduces pressure on rates over time, but it doesn't guarantee rapid price growth. Wage growth, supply levels, credit availability, and buyer confidence all play major roles. In 2026, property markets are likely to remain fragmented, with performance varying widely by suburb and property type. What inflation does tell us is this: uncertainty remains, and risk management matters more than prediction. Here are 3 practical takeaways. First, stress test your finances. Whether you're buying or investing, assume higher costs will persist longer than expected. Second, focus on local data. National headlines don't buy or sell houses. Local vacancy rates, rental demand, and employment trends do. Third, think long-term. Inflation comes and goes, but quality assets in strong locations tend to outperform over full property cycles. To sum it all up, the latest inflation data shows progress, but not victory. Cost pressures remain real, interest rates remain influential, and property decisions in 2026 require caution, planning, and clarity. If you're planning to buy or invest, speak with professionals, understand your numbers, and avoid rushing decisions based on short-term headlines. If you found this useful, subscribe for more property insights.